Let's talk money.
Welcome back. You're watching the capital gains tax classroom when it comes to mutual fund investing, because so much has changed after this budget. And of course, we have Mohit Gang as well as Devendra Singhal to take our questions and help us understand this issue today. We were speaking about multi-asset funds just before we went into the break, and I want to bring in Devendra because he manages those funds at Kotak KMC. So Devendra, great going, right? Not only are asset classes like gold giving you such a great return, now the tax is also looking better. So what's your advice? And to the point that Mohit made before we went into the break, that now that the tax rate has come down, will we see these funds invest more in commodities like gold?
So, Surbhi, as you define multi-asset, multi means thus you need to have at least 3 assets with minimum 10% weight. Now, there's no, limitations in terms of how much one category can invest into the other. It all depends on how you have basically positioned your fund in terms of taxation. So you're right that with taxation angle going off, now you could have a more aggressive call in terms of higher allocations into particular assets like gold, international equities, and debt and all, and still get a benefit of lower taxation what was earlier. But this thing is now happening with more of fund of funds, which is the multi-asset allocator, which is the fund of fund category. In categories whereby you are investing directly into securities, I don't think there's any change in the categorization now. So that remains as it is, and it's lucrative.
Okay. Again, just asking you a basic question, if someone's looking to get into a multi-asset fund, what would be the realistic rate of return to expect? I know, we're not asking you to, promise something over here, but typically, depending on the asset class shifts.
See, typically when we look at, multi-assets or any hybrid schemes, we look at a ratio called upside-downside capture ratio. That is how much of when the market is going up, what percentage of the upside I'm able to capture, and when the market is going down, how much participation I'm having on the downside. Typically, over a long period, we have seen that this upside-downside ratio for most of the hybrid funds has been more than 2.5 therein. I think that is what we should look at rather than, looking at the absolute amount of returns. Because there are few funds in the category which have actually beaten the Nifty also over a long period of time. But having said that, if you have a lower amount of equity, then your returns should actually be lower than what the overall market returns are. Now, it is now depending on what you can do in terms of upping and lowering your equity allocations or other allocations which can give you that alpha, right? So I think that I'll leave it there without commenting as to what kind of returns one could expect. But definitely, if the endeavor is to mimic market returns, but since the equity component is lower than the market, one should have reasonable expectations around.
So let me just ask you, as a fund manager, when you see a particular asset class doing so well, like gold right now, typically, how do fund managers think? Is it time to book some profits and lower the holdings? Or, do you take a view, as in the view right now, that perhaps this is a long multi-year run, so therefore, and now that you're not bound by taxation, that you can actually go ahead and increase holdings in precious metals?
So, Subhi, not everything is bought just for the returns perspective. You need to have risk also into your mind when you construct a portfolio. When we talk about multi-asset allocations, we are talking about 3 different asset classes coming in on a minimum side, and asset classes are supposed to have low correlation between themselves. So it is basically to give a smoother ride to the investors for a longer journey they have in the market, rather than just focusing on the return part of it.
Fair enough.
Having debt, having gold as an asset reduces the volatility which equities can provide. So it makes your journey a bit more smoother than what would have been on a normal side, just been equity. So I think that is what one will need to focus on rather than just looking at the pure returns purpose.
Fair enough. All right. Let's quickly move to the next category, which also stands to benefit a lot because of the change in taxation. And this is the global funds category, international funds, which are investing in, whether it's US equities or maybe you even have some greater China funds and whatnot. Now here as well, This category was first taxed at our slab rate, but now it's going to be taxed at 12.5% if the holding period is 2 years or longer. So Mohit, this sounds great. But, correct me if I'm wrong, a lot of funds were not taking any fresh money because of certain limits being hit already.
Yeah.
So is it even possible to invest right now?
It is. Quite a number of funds are accepting fresh investments. Few are accepting only as SIPs and few are open for both lump sum purchases and SIPs. It depends on the contours of the fund. Funds which are purely ETF based, those are the ones where the limit has got busted and those are the ones which have stopped. But funds which are actively managing their allocations, perhaps directly investing into stocks or international stocks directly, those are the ones which are typically open. There is a whole list of funds, but I think category as a whole, Surbhi, has got a huge impetus. And needless to say, for an Indian investor, it's absolutely must to have a global diversification. Given the profile of our currency, which has been depreciating against the US dollar for almost last 20 years, if you see the track record, the depreciation has been on an annualized rate around 3 to 3.5%. If you want to counter that, if you want to have a real hedge against the country risk or the sovereign risk, or you just want to create a corpus offshore for your children's education or for anything, let's say, I think this is a great avenue available to retail investors, that you go out and invest in international funds. Again, this category got completely out of flavor last year when the taxation was changed, and now it's come back into reckoning with full power and full force. And I think all investors should definitely look at diversifying abroad.
Your favorite funds here?
Look, many. Honestly, I like the Edelweiss US Technology Fund. I like the DSP Global Innovation Fund. These are all active ones. But on the passive side, I like the NASDAQ fund of funds, which currently the open one is only Motilal. I think they're accepting SIPs out there. So if someone wants to buy NASDAQ directly, I think that's a good avenue to go for.
Okay. I mean, if you can put all the recent market volatility aside and look beyond and not get worried about the churn in global markets, right? Okay, we have time, I think, for just one question. Debt funds, there's no change to the best of my knowledge. There's nothing that sort of changes. It was slab rate earlier, it's slab rate right now. But we have a question from Abhishek. He's saying that he invested into a debt mutual fund in 2017. Okay. And this was his mother's name, who's a senior citizen. He's saying, what happens now if I redeem the fund, if I sell the fund now, is there any long-term capital gains tax advantage for me?
It is. Interestingly, this category, though, remains unchanged, but for people who invested prior to 1st April 2023, which is when the new debt taxation regime came in.
When the indexation was taken away and it was
taken away and it was put at slab rate. If you've invested prior to that and if you're selling after 23rd of July 2024 and if you have completed 2 years of holding, right, on your debt funds, then you will be taxed at 12.5% after 24 months for your previous holdings, right? So you still have a huge advantage, though you have lost the indexation benefit, but you still get taxed at 12.5 after 24 months. So it is, I think he can rejoice on that.
Okay, fantastic. We have just 10 seconds left. Devendra, any final advice to our viewers when they're approaching hybrid funds?
Hybrid funds gives you diversification. It gives you a risk-adjusted return. So keep that in mind because risk is always hidden.
Well said. Those are wise words to remember. Thank you so much, both of you, for joining in and helping us navigate through the new tax regime for these funds. I really look forward to more such conversations. Well, with that, it's a wrap on this edition of Let's Talk Money. We'll see you again, same time, same place next week with yet another theme on investing and your money.
Let's Talk Money